right, well, good morning, everyone, and welcome to the Wednesday, April 1 Economic Development Committee meeting. It's 8:01. Let the record reflect that Councilor Wildline, Councilor Salah, and Councilor Moe are here. I was the pastor, so I'll just get us until we get to item 3 to elect a chairperson, because it is a new 2-year term. So thanks to Councilor Burgess for serving, and welcome back, Councilor Salah, to Economic Development. So the item number 2 is to consider the minutes of the October 3rd, 2025 Economic Development Committee meeting. Do you guys have any?
Yeah, so move.
Moved?
Second.
All right. All in favor? Aye.
Aye.
All right. Now we move on to 3, elect a chairperson. I am happy to continue to serve. I'm happy to support either of you. There are no special rights or privileges. So whatever you guys want, I don't care.
That's okay with me.
That's totally okay with me, yeah.
Okay. All right.
We elect you. We move to elect you.
Okay.
And I second.
All right.
Yeah.
Well, thank you very much. I won't make a speech because I'd like to get on to item number 4.
All in favor?
Oh, all in favor?
Aye.
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 Any opposed? All right. We will move on to 4, the review of the designated endowment fund agreement for the arts endowment. And that's going to be Rachel.
Sure, I will take it. Rachel Gilbert Barley, Economic Development and Public Art Coordinator. So there was a staff memo included in your packet, and I'll just kind of do an overview of that. But as you'll recall, through your FY 2027 budget process, you all agreed to support the establishment of an arts endowment fund in partnership with the Community Foundation of Johnson County, using a portion of the lost revenue, and then some general fund revenue stepped down over time. So there's kind of 3 interlapping components that we often talk about when we're talking about our arts funding strategy. So the first is this endowment, which is really intended to be that like long-term funding vehicle, provide that long-term source of funds. And then the annual operating support, that's the program that has historically come through the Economic Development Committee. We currently have 5 what we view as institutional arts organizations who receive operating funding from us annually. Through this process, we'd look to continue, ideally expand that to at least 1 more, Public Space 1, and then kind of formalize and stabilize that over time. And then third is the Iowa City Arts Alliance. That one has probably less bearing on what we're going to talk about today, but just being aware that it's happening. That's a partnership that is going to be led by the Iowa City Downtown District for the next steps. And then just understanding that, over time, these are all kind of very closely connected. So any one decision in one area could potentially impact the other. So thinking about next steps in terms of the endowment, just wanted to lay out what we view as what those next steps are. So the first would be establishing the legal and financial structure. So that's what we are hoping to kick off today. We've included that draft agreement with the Community Foundation of Johnson County in your agenda packet. And that kind of just, the key item in there is really the purpose statement, which identifies what that endowment fund would be designated for. Following that, once it kind of moves through this committee and is approved fully by the city council, our next step would be to create kind of the process and procedure around some of those more detailed questions of who makes decisions, how are the distributions requested, what exactly can it be used for. So that would be the next step to work through that. In the staff memo, I've kind of described that as some sort of internal policy. In talking with Shelley Meharry, who's the executive director of the Community Foundation, that would more typically be described as like a Schedule A attachment to the original agreement. So we work through all of those details, again, first through this Economic Development Committee, and then draft that Schedule A attachment for the final council consideration and approval. During that time, then we'll also be, of course, starting contributions to the endowment and continuing our annual operating support with the arts orgs. And then the third kind of phase would be defining the operating support allocations. So once you've kind of established the endowment, put some parameters around that, then we need to return to these annual operating funds that we provide to the different arts organizations, as we've discussed in prior meetings at City Council and here in this committee. Those allocations have just evolved over time. They've come at different times to the City Council for consideration, and they've kind of been absorbed into the city budget. But there's, no true formula or anything like that to help people understand, why the funding is at the amount that it is and who receives it and how it's considered. So that would be our next step, would be to work ideally in collaboration with those arts organizations and develop what that allocation framework looks like, so it's more consistent, more transparent, and it's also more reliable for the organizations so they can kind of plan ahead.
Does that allocation system that we would establish, would it be baked into the organizational agreement that we're developing right now, or is that something that could change over time? Is it something we need to establish we need to fix at the establishment of this agreement with the community foundation?
So at this time, we would just be recommending moving forward with the agreement that was included in your agenda packet, so just the base agreement,
Yeah.
and then we would do that attachment, which defines some of those details, and so we could consider including the allocations in there at that time. Hadn't thought.
No, there's a lot of steps. I'm
Yeah.
trying to understand what needs to be done at the beginning and what can be modified over the long term. Because I know that's going to have council's going to have a lot of thoughts on that. I think the whole
Okay.
council will. So, and it'll take a long time, I think, to tease out. So,
May I also offer? Hi, I'm Shelley Meharry with the Community Foundation of Johnson County. Establishing the fund really creates the vehicle in which to receive funding from the city, and it's the intention that that will grow over time. So there would be a period of time before an allocation happens, and so Schedule A will be the defining piece for us that dictates where the funds, how the funds will either come back to the city or how that process will happen. But it is intended to be as we move forward in the coming years, it'll take some time before there's a distribution coming. So to kind of
sure.
that's how I saw this working.
I would describe it kind of as, the overarching framework is this base agreement that creates and establishes the fund. Within that, we would have the Schedule A, which kind of would outline the policies and procedures in general for the endowment, and then we have funding programs within that. Right now, it's just the operating funding that we provide to the arts organizations. So that would be the third piece that then you define inside.
In our packet, you provided the past charts that we have seen about when the city contributes, and I think that's page 10 of 16. And it looks like it's maybe year 1, 2, 3, 4, 5, 6, 7 is when we actually start using money from this endowment. Is that's that time frame that you're talking about is 7 years maybe before we really need to.
That's our best projection. I think through the creation of the policy, we would want to identify what that minimum balance is in the endowment before we want to begin drawdown.
But those are policy decisions that can be made later. They're not part of the initial creation of the vehicle. Okay.
The most important piece, for at least from my perspective right now, to open the endowment to have it be a vehicle is I'm as long as everyone can hear me, okay, I'm fine.
Okay.
It's the purpose statement within that agreement that's the kind of governing document that outlines what the fund can be used for.
Okay.
So as long as that's set, then
Okay.
then next steps will follow.
Did you guys have any questions?
Is there still more to go, or in just your overview? I just want to make sure I don't ask a question that you're going to address.
Well, then the final phase is just that ongoing implementation. So it's really once everything's in place, how we continue. Again, thinking long term, based on the projections that were included, around FY 2033 is when we would start to see that difference in what we have funding of coming in versus what we're planning to spend. So that's could potentially be a time when we evaluate opportunities to expand or adjust. But what we would be deciding in the next couple months to year would be more for that short term approach.
Just to be clear, it's not like there's no arts funding for the first 7 years. It's all general fund
Yep.
funding until,
Yep.
just in case there's anybody in the room who's anxious that there would be a 7-year gap in funding. That's
Yeah.
not the intention.
Yep.
I suppose one thing that I think during a work session, maybe a couple months ago when we were talking about this, a couple things, you know how us arts people are, that when I would explain to some folks in the community about this this program or this endowment proposal, there was excitement, and then there was also, well, what are we investing in? You know, and I know I brought it up, and I was aware that there was the community foundation had a ethical investment portfolio, something like that, right? But sometimes it doesn't have as good of returns. I don't know exactly what the criteria is for the ethical investment portfolio. If what I'm envisioning or what people's concerns were to me needs to be as strict as what that portfolio could be. I think, you know, people were saying, I don't want our arts money to come from us being giving money to Raytheon, you know, or RTX, what it's called now, or something like that. That's just what I've heard, concerns that I've heard, and yeah.
Shelley, do you want to share
Sure.
information about past?
Yeah,
Returns.
so all of our endowment funds, so when an endowment fund is started and new funds come in, we have a standardized portfolio that we put those investments in. It's commingled, it's invested across 4 local financial institutions
Okay.
that manage according to our investment policy. So 99% of our funds are invested that way. It's part of, you know, the pool grows, it's divided and distributed. Our,
So it's not like for this, you're not going to start from square one and be like,
No.
okay.
my suggestion would be that these dollars are commingled according, you know, that these dollars would be invested according to all of the other endowments that we have. That's our standard. That's how we're able to track appropriate returns, distribution, you know, the co-investment raises all boats essentially.
Yep.
So that would be my recommendation. However, if there is council direction that you want to explore, you know, another investment vehicle, we can certainly do that. We do have what we call a socially responsible fund. We just have, it is not widely being used. We actually have just one church that's using it, but it's available. So what I would offer is, based on council direction, we're happy to explore what you need.
I assume you don't know off the top of your head the performance difference between, that would be part of that decision making, I assume,
Yeah.
is looking at the performance differences between those two funds.
I don't with me
Okay.
today. I just have the general performance of our.
I think when this comes to council, it seems like something we'd want to know. But back to the order of operations, we theoretically are engaging in a relationship whereby we could, at a regular interval, change investment vehicles if you wanted to. Like, can we switch between the standard local option and like what are the options for the council, each different council over the next forever, how long?
I would say we could work in an annual review. I don't want every quarter having someone different say I want to do something different. I think annually after performance review, I think that could be an open an opportunity for review
Okay.
for sure.
Like that.
Yeah. It just seems maybe right now, since we're giving direction about the overall agreement with which the fund will be made, is there a way that we can just look at the overall portfolio of this? Could that be sent to us?
Sure.
Or okay.
You're specifically meaning the socially responsible fund.
The fund that you're recommending. The general, yes.
So that's a little bit more complicated than give me the fund. So our investment policy dictates what our investment managers can invest in. Then we have 4 different investment firms locally that are investing the dollars.
Okay.
So we can provide you with the portfolio information of what's been invested.
Okay.
Sure.
Okay. But there's no necessarily like they could just invest in something else. These 4 entities, in the meantime, or
Yeah, I mean, there's nothing restrictive. I mean, our investment policy does provide restrictions on investment. So, non-publicly traded securities, for example, commodities are not included. There's some restrictions, but in general, our portfolios are made up of, mutual funds, index funds,
Okay.
maybe some individual stocks, depending on the individual broker.
mm-hmm.
So there's a broad mix there.
Okay. I mean, I think a good way to start would be to, if we have any performance differences or projections of the two,
Sure.
and what that could look like in the future. And also what I was saying before, just what the current portfolio looks like and what it is right now. Like I said, it's not. I know that these things are very subjective, right? One person could call something unethical, Someone could say everything is, but when it comes to like certain things that were brought up to me that are kind of a line that they didn't want to be crossed to for arts investment,
Sure.
I guess that's just what I want to make
Sure,
of,
and
yeah.
I completely understand. We'd be happy to provide the return information for the socially responsible fund.
Mhm.
Return information has already come to Rachel for our general pool. We can do the comparison, and then council direction can provide any additional information they need.
Okay, that would be great.
Yeah.
Thank you.
Do you have any other investment questions? I had a policy question or two.
No, I just wanna, in the top of your head, do you know what's the restriction that you have for the investment?
I'm sorry.
The you said your policy have a restriction for the portfolio. With the investor, do you have, or do you remember what are the restrictions that the people can not use it for, invest for?
So it is what the community foundation can use for investment, and it's outlined in our investment policy, which I think Rachel has as well. We can.
That was in the
That
late
to you.
handout. That we did go through that.
Yeah, maybe that would be helpful to go through the late handout. I had a handful of questions on the policy heading, but maybe we go through an order, even or present it, Rachel.
Would you like to present your own policies? I can do my
Kind of a
best.
key player here. We could get you at the table eventually.
Sure.
We just.
But I can do it. I knew I'd like to do.
No. No. So how the investment policy works is this is not an individual investment policy. This is the community foundation's investment policy. So when dollars come to the community foundation, we have a policy in which our finance committee directs how the dollars are invested. This policy, so have been committed from the outset of the community foundation to utilize local investment management firms, local banks, to invest our community foundation dollars. This policy goes to those 4 investment managers and it basically outlines for them how they can invest the community foundation's dollars. So it basically provides the parameters of the amount of equities, the amount of fixed assets, the amount of cash that they can hold. And it's quite broad. We give our investment managers the ability to use their expertise to manage these dollars, knowing that they're for community good, and supporting the operations of the community foundation and the other work that is happening. So you can see it's outlined what the percentages can be, what is permitted investments, what those can include, and then I think there is.
And the idea, while you're looking for that, behind outsourcing the investment portfolio to local people is to make sure that it's not the board making investment decisions, which could set all kinds of ethical issues up.
Right.
And also you want to outsource it to experts who have fiduciary
I should have-
responsibilities.
I should have highlighted in this exactly what I'm looking for.
It's okay.
Sorry, it took me a hot minute.
That's okay.
So prohibited investments and transactions include commodity trading, more like day trading. We don't want any of that. Future contracts, purchase of restricted stock, and non-marketable securities, short sale, and margin sales, which would be the fringe anyway. But things like mutual funds, individual stocks are all permissible for the investment advisors to use.
Sure.
The portfolio managers that we have now are housed at U.S. Bank, Midwest One Bank, Hills Bank, and United Iowa Financial. Those are our four primary. United Iowa Financial had been the investment managers for University of Iowa Community Credit Union, then Green State, and then they parceled off on their own, so they have a different name. But those are the four key
Sure.
locals that we use.
Well, I guess since you're on bullet point H on this, you say that there is as any financial investment, there's a risk of loss. What do you recommend to your current endowment holders, I guess, when there is a downturn, when you're in a recession? Do you continue to spend 4% per year, or do you ask them to tap the brakes and not spend in a downturning economy?
So that's a great question. We have a spending policy. I think that was even included in the
that's in
packet,
the
perhaps. So when these investments an endowment is created for the long term. So we take a long-term perspective that they're invested for the long term. We have a formula that helps our finance committee determine our spending grant from the endowment fund. So right now it is 5% is the maximum that is able to be spent from endowment funds. It's the gold standard across industry, and it's also dictated because when donors give to any endowment fund held at the community foundation, they're also eligible for the Endow Iowa tax credit program if they are an Iowa state taxpayer. So the 5% is also dictated by the state as well. So we've got multiple factors identifying 5%. Historically, using our spending policy, we've always been able to maintain the 5% spending. Other community foundations allow less than, or are spending out regularly less than 5%. I think there's a couple reasons for that. We, by the nature of keeping things local, our local investment managers are keeping their expenses for management well below market rate for us. So our expenses are lower, allowing for more flexibility in, how much is built into how much the growth is in the endowment fund. So with that said, we've always been able to maintain a 5% spending. We know that in the years also that growth has been, and I'll give you the numbers. I mean, we've had a couple exceptional years. Our return for December 31st, 2025, these are year-end returns, 15.65%, that's net of our fee, so that's what's been returned to the fund. 2024 was 13.7, and 2023 was 16.3. 2022 was a strong down year, which we probably remember. The endowment was down 18.3% across all of our funds. But knowing that you're buoying that over time, we've been able to maintain the 5%.
Okay.
And also knowing that our nonprofits are, we're hoping that our nonprofits are relying on that steady stream of funding, that it would take a significant amount for us to veer from the 5%. Because we want the nonprofits to plan for it.
And what's the if council were to choose to participate in a an ethical investment fund like the church that you mentioned, and it had a lower rate of return, then you would just ratchet down the recommended amount of return, or not return, but I guess usage or harvesting. I don't know what the right term is.
Yeah.
You just ratchet that percentage down.
Well, if needed.
Yeah.
I mean, our plan would be to, hopefully it will maintain at least the investment return that we need. And we would, if there is a specific vehicle that council would like us to use, those dollars they're not going to be commingled into the general pool. So you'll be able to like see your portfolio of what the return is and make decisions from there. We don't want the endowment to go underwater.
Right.
So, because that defeats the purpose of trying to have it grow. So that would be a case where we would say, let's let it continue to
Yeah.
grow.
I feel like at this point we don't have to pick an investment, but I think everybody's kind of interested to sort of see
And
both of
I'm-
those. Like,
and
what's the cost of this?
Right. And that's, I think that's part of your natural due diligence policy, and you're investing public dollars, and it's really important to understand those pieces and make the right decision for everyone. We absolutely understand, for sure.
Shelley, would that need to be defined in this base agreement or in the Schedule A? If they elected to choose like a different portfolio?
I would probably include that as like a Schedule B of what the
Okay.
portfolio will be. But again, until the time where dollars transfer, like we would have time to figure that out.
Yes,
Which is when the dollars transfer.
Right now, so July is when it begins, but we won't start accumulating funds for a few months after that. So we think our first deposit could be around October.
Okay.
And we would do that maybe quarterly or twice a year. So
Sure.
we don't know what that amount will look like yet, but
And I also envision, like, yes, since this is city dollars, obviously the city council should have a say. But I envision kind of like maybe if there's pros and cons to each, trying to have some sort of holistic conversation with the arts community itself. Like, here are the pros of this. Here are the pros of this. This is a socially conscious fund. Maybe you get a little bit less returns, but this. Here's whatever mechanism that would take. That's kind of what I envision is bringing them to the table. I know that that's easier said than done when it comes to an eclectic group of arts community.
Is this do you think this committee is the right, invite them to an economic development committee meeting to discuss that? Do you think that's the right? I don't know, Rachel, you've had a lot of interactions with the arts community regarding the Arts Alliance. Have you talked about investment at the same time?
we have not.
Okay.
I think when we talk, I think once we hear more and we have like more information in front of us, then that's a conversation we could have.
Do you talk about like talking to the art community about who the investor will invest in? That's what you're talking about?
Yeah, like we have option A, option B. The
Standard versus the
standard versus socially conscious, like what the returns look like and what the investments are, or what the just if
But
when
what's
we have
the
that.
goal of that? Because I felt the goal, like we as a council or as a city, to make sure we are not investing in something that we don't like our
That too.
money to go to.
That's why I said we should have like
But-
the final decision, but just to have them at the table to see their feelings about it and what they would prefer.
Okay. Then I think have them maybe when we review, because we need also to review what the investor are investing in. And you said this is going to be annually, or we can do it. I don't know when we can do that, but I think it's better for us to bring them to the table and make that like this committee
Yeah.
Okay.
than like the community foundations.
Okay.
Yeah.
Yeah.
I just think that's the right way, maybe.
I-
Because we are the one who caring about that. Like as a city, we care about what those investors are investing in because we don't want them to go invest in something that we don't want them to do it.
Yeah.
So, and we can talk about it with them. We bring them here and say, hey, this is our idea. Blah,
Yep.
blah.
That's what I'm thinking.
Sure, yeah.
Yep.
I wanted to ask, so in the procedure for grant making and due diligence policy, there is a policy section about how, and it's all good stuff that I appreciate very much, about how how the community foundation is making choices on who can receive charitable funds. I'm curious what the intersection of that and city council is. Will you come to, we have this new organization that's actually granting out money. If city council says, hey, we'd really like to give money to organization X, and they've not managed their finances very well over the last many years, what does that look like?
Sure. So just to kind of define this policy. So this is the policy that defines how community foundation would perhaps use our unrestricted dollars to make grants. When we manage a grants process, this is outlining community foundation's due diligence. In this regard, we are being asked, well, there's a lot of flexibility here, but on the outset, it seems like Community Foundation is being asked to be the charitable investment partner for these funds. And the 5% spending would actually return to the city or committee or however is it's decided to do your own due diligence on who receives the funds. So from our perspective, as long as you're fair and
The city follows these
well, and you'll have a fair and equitable grant making process within to do that. We can also recommend, if you would want to give a grant to an organization that we always lean into trust-based philanthropy, right? We believe that the nonprofits are going to use the dollars in the manner that best fits them and according to whatever parameters. We can always implement what we also call expenditure responsibility, which is give the dollars to the nonprofit, but just add a layer of accountability, which is show us how the dollars were used.
Exactly.
It's just like one extra layer. And we can certainly help with that.
I think this is going to be like any another kind of grant that you guys do, where you have report and all this thing like financial report and also project report. Yeah.
So when you explore Schedule B, which is the kind of creating how the dollars will be used, there'll be, there'll be several options that you can explore. One is just having the distribution come to the city and being managed by committee. Community Foundation can also be involved if you want in sort of the application process of collecting the applications. If it would be a competitive sort of grant making process, or if you're just designating based on organization. So there will be a lot of flexibility there, but in my understanding right now, we are the charitable.
Yeah, council doesn't want to give up the ability to make its own decisions. Yeah.
Right. And we will be as helpful as council needs with any information.
Sound good.
Do you guys have any other questions?
All of that being said, I think this is really exciting.
Yes, it is.
I think it's a really cool problem solving, really good problem solving for budget.
Yeah, the city's commitment to make a long-term investment to support the sustainability of the arts is really a shining star that we're not seeing in many. I recently attended a conference with other community foundations and really just kudos to the council for being so forward-thinking and wanting to make a long-term investment.
Thanks to our professional staff for setting it up.
Thank you for bringing the idea and the stuff. Yeah, good job.
Well, I made some homework items,
Yes, thank you.
and I'll follow up with you, Rachel.
Is there anything on item 4 here that you guys feel like would prevent us from saying let's go to the full council with
No.
this agreement?
No.
Let's
We'd
go to
like
the full
have
council.
the investment conversation with some of those other details at the next EDC meeting.
Yes,
That sound
maybe.
great?
Yeah.
Yeah.
So is the correct action for item number 4 that we move this on to the full council for review?
Yes.
Okay. You
Yes.
want to move?
I move that to send it to
Okay.
the council. Yeah.
All in favor? Aye. All right. So full council here. Thank you.
Thank you.
Mr. Harry.
Thank you.
Expertise.
Thank you for everything you do. Thanks.
Moving on to item 4, which is discuss proposed residential tax exemption program.
Good morning.
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 Nora Cahill, Public Policy Analyst. While we pull the PowerPoint up, there is a memo in your agenda packet. I'm going to be mostly going through that memo. So
Sure.
Very energy efficient.
Thank you. Thanks. Thanks, guys. And it looks like it starts on page 11.
Thank you.
all right, I'm going to start with explaining why staff have been exploring tax exemption as a policy option. I'll move into the basics of tax exemption and how it works, as well as how Iowa City has pursued it in the past. I'll get into how Iowa state law governs tax exemption in municipalities, and finish with a proposed framework for feedback. So why are we talking about tax exemption this morning? There are a few good reasons why staff have explored this. First, the strategic plan calls for higher density development. We're moving in that direction pretty slowly, and more multifamily development could take us towards that goal more quickly. Second, we know that Iowa City needs a larger housing stock. The existing conditions analysis for the ongoing comprehensive plan update finds that we need just over 9,000 new housing units by 2050 just to keep pace with population growth. That comes out to about 364 per year, and city data shows that we're not meeting that goal right now. Between 2020 and 2025, average multifamily permitting came out to about 168 new units per year. That is sluggish compared to the 6 years before that, when we had almost double that amount of permitting per year. We also know that in recent years, new multifamily permitting has been dominated by student and senior-oriented housing. These fill an important role in our housing market, but don't fill the need for individual and family units that anybody can apply for. So for all of these reasons, staff have kept this goal in mind, looking for policy options to increase our multifamily housing stock. Tax exemption exists in contrast to a lot of other tools, especially TIF, which I'll reference a few times on this slide. Tax exemption works by reducing the property tax obligation of a property after a new building has been constructed or after an existing building has been rehabilitated or improved. It has a strong foundation in Iowa state law and is used in many Iowa communities. As of 2024, it can't be applied to school taxes, which are about 40% of the tax levy in Iowa City. Tax exemption is applied in urban revitalization areas. This is a really similar role that urban renewal areas play in TIF. To make it easy, they have the same acronym, but they are different districts. This is in contrast to tools like TIF, which relies on anticipated future tax revenue to support current development. TIF can be a larger subsidy than tax exemption can in general. And tax exemption, importantly, is not decided case by case. Once you establish an urban revitalization area and there is tax exemption applied in that area, any property that's eligible for a tax exemption can receive it if the property owner applies. This is very different from TIF, where every agreement is negotiated. And then finally, I'll get into this a little bit more on the next slide, but tax exemption is generally not quite a deep enough subsidy for affordability requirements. There are exceptions to this in other communities, but it's not always the best fit.
So can you bullet point case by case? Maybe decide
Yes.
case by case.
So
What's that
other
mean?
tools may be decided but case by case. So for example, TIF, if we're going to develop a TIF agreement with a developer, that goes through negotiations for that specific property.
Okay.
Tax exemption is applied the same way for every property that's eligible in a district.
Maybe it's case by case is a TIF characteristic,
Yes.
not
Other
a. Got it.
tools may be decided case by
Sorry.
case. Tax exemption is applied uniformly across a district.
Thank you.
Tax exemption can help communities increase their housing supply, and communities across the U.S. have seen success with this, especially when it comes to middle-income housing, between around 60 to 120% AMI. While this is only one segment of the housing spectrum, it can have ripple effects throughout the entire housing market. When you see middle-income households face a scarcity of appropriately priced housing options, like many households do in Iowa City, they have two options. First, they can reach for a unit that's not quite affordable for them, and then they face a housing cost burden that they have to bear. The alternative is for that household to find a lower priced unit, and that relieves the housing cost burden on that household. But many times, middle income households will outcompete lower income households for the same unit. So by increasing the middle income housing supply, we could loosen up that low rent housing supply and make it easier for especially high barrier households, elderly, disabled, folks coming out of homelessness to find housing that they can afford. Tax.
But is this? No, I really don't get this. In the beginning, as of Bay, you said this is not necessary or reduce like the housing cost, like it's not make it affordable units. That's what you said.
When I say affordable units, I mean capital A affordable with an income restriction and an affordability requirement. I'll get into that a little bit more on this slide, but in general, tax exemption can be a really good fit for kind of the middle income housing range. That's not necessarily the highest cost in the market, but also not
The low income.
right, doesn't include a lot of affordability requirements. So it can ease these housing cost burdens for middle income households and also kind of release or reduce competition for these lower cost units that that low income households really rely on. Tax exemption does come with some major considerations. When tax exemption policies fail, it's usually because it's not been tailored properly to the community. If you have a tax exemption policy that's been applied too broadly, or when the amount is too small, you'll end up subsidizing development that would happen even without that incentive. When we develop things like tax exemption, we use what's called the but-for test, where it should be targeting development that would not happen but for the incentive. On the other hand, if the tax exemption policy is applied too narrowly or has too many restrictions, you'll see the subsidy not get used at all, and it won't move the needle at all on housing supply. Coming back to affordability requirements, there are a few reasons why this isn't a strong fit, at least in Iowa City. Some communities across the country have included affordability requirements. These are generally in the range between 60 to 100% AMI, with some exceptions that focus on lower income households. First, we've gotten guidance that we would need to do a bit more digging into state law to make sure that that affordability requirements would be allowed. Second, especially when it comes to this 60 to 100% AMI range in Iowa City, there are some quirks in the housing market that make this really, really difficult to execute. In that 60 to 100% AMI range, affordable rents, affordable as in 30% of a household's income, can be higher than what we estimate market rents to be. This is partially because it's really hard to get good data. And partially because Iowa City is a very unique housing market. So if we were to impose affordability restrictions at that 60 to 100% AMI range, we would be imposing an administrative burden on a developer or an owner without reaching any public benefit, because the affordable rent would be higher than what they would be charging anyway. If the affordability restriction is lower than that 60% AMI range, 50, 40% AMI, that's when you start to see developers needing a deeper subsidy or requesting a deeper subsidy to provide and maintain those units. And then finally, tax exemption is a great fit for mixed income development. It's not generally used for 100% affordable development, often because 100% affordable development is usually done by nonprofit owners and developers, and they are already exempt from property taxes, so they can't use this kind of tax exemption. Sorry, you have a question?
Yeah, I didn't want to interrupt you though.
Yeah.
I want to step back to the idea that, is this really just for the production of single-family housing, owner-occupied single-family housing? Because I'm trying to
Absolutely not.
tether the AMI requirements to the rent, to the how are you? If it's a property tax reduction for a rental, is it possible? Mechanism, and then they would have to enter into agreement to have a reduced rent or a subsidized rent or a capped rent to satisfy the needs to get the
If there is an affordability requirement. If
okay.
there's no affordability requirement, a multifamily rental property could still get that property tax exemption.
Okay.
And I thought I read in the memo that there was specifically that this was being proposed for multifamily only.
Yes.
Okay.
Okay.
Yes.
Yeah.
Yeah, so
Yeah.
the pilot proposal does focus on multifamily only.
I think we need to increase the supplies of multifamily housing, but I don't know, somehow if we, I don't know, you said this is not permitted by the Iowa law that to require affordability when we give tax exemption.
It's dubious. We would need to do some more digging on that front. The purpose of the state law is to apply it as uniformly and broadly as possible, and the purpose of that state law is not to include a lot of restrictions. So it's possible that it would be allowed but not an intended use of that state law. We've been in touch with the economic development attorney that the city consults, and his take was it's probably allowed but not recommended under state law.
And how the other city is doing it, but because this is a state only law, our state law,
That is, yeah,
which is different from others. Okay.
It is governed by state law. There are no Iowa communities that include an affordability requirement.
Okay, it's not in Iowa. Okay.
Yeah. Iowa City does have a current residential and a commercial tax exemption policy. Our current residential tax exemption allows for a 40% tax exemption, and I'll get into what all of these numbers mean. 40% tax exemption for 10 years on any multifamily developments over 6 units that include 15% of units under 40% AMI. Again, this is
super sorry to interrupt. I'm so sorry. If we're not sure it's legally allowed, then how are we doing it right now?
so we do not.
Yeah, go ahead. No, I don't want to answer. Okay, you go ahead.
We don't have any urban revitalization areas established in Iowa City. We have an invitation for developers to apply for tax exemption, and if they wanted to take advantage of this policy, we would establish an urban revitalization area, establish tax exemption in that area, and allow that developer to use tax exemption. But we have not gone through the process already of establishing those.
Okay.
It's more like a voluntary.
Yeah.
They would be the catalyst to create that area, rather than a requirement.
So then
Okay.
instead of saying any property within this district that has 15% of units under 40% AMI can get this tax exemption, you'd be saying this developer has applied and has requested that an urban revitalization area be established for their building. They have shown that they meet these requirements. So we're going to establish an urban revitalization area where anybody in this one spot that has one building.
Yes.
Can
Like by
receive
project
tax
kind
exemption.
of like, yeah.
That makes sense. And do we think that part of the reason why it mentions in the memo that we have not had any people come to us, would it be fair to say that if this was structured in the way that you're proposing, but also with the affordability requirement, that we might get more traction that way?
It's possible. I think one of the reasons why developers have likely not applied for this is because there isn't an urban revitalization area already established. Doing that takes several months and multiple actions by council, multiple actions by staff. It adds to the development timeline and adds some uncertainty in ways that developers usually try to avoid. So it's certainly possible that that's one, that is the main reason why developers have not applied for this tax exemption before. But also likely the 40% tax exemption is probably not enough to cover the cost of providing those affordable units.
Okay. At 40% AMI.
At 40% AMI.
Yeah.
We also have a commercial tax exemption policy. These are governed by the same chapter of Iowa state law. The proposal that I'm going to end with is focused just on residential, but since we do have commercial tax exemption and urban revitalization areas for those tax exemptions, I wanted to highlight those as well. These are mostly along Highway 1 and Highway 6 and focus on older commercial areas and provides a 100% exemption for 3 years. and this has seen more use since 2021.
And this is, we've seen the car wash on Highway 6 use this program maybe.
Yep.
Yeah.
Several contractor bays would be the bulk of it. The South District Market and conversion of the Slumberland.
That
into
was the
storage
South District
was one.
Market. Okay.
So this is where I'm going to get into what all of those numbers mean, and bear with me for a little math. Tax exemption in any given year is calculated as the percent of the improvement value of property that's exempt from property taxes, except school taxes again. So the improvement value is calculated as the difference between the final value of a property after an improvement has taken place and the initial value before any of that improvement was started. So for example, let's take a $100,000 piece of land with no buildings on it. Let's suppose that a $4 million building is constructed. Now the total property value for that property is $4.1 million, but the improvement value is $4 million. It's just the value of that building. Without any tax exemption, that property would face a tax obligation of around $73,000, taxes payable fall 2026 to spring 2027, as an example. Let's suppose that this property for that year is eligible for a 100% tax exemption. So 100% of that $4 million is exempt from property taxes except for school. So we start with the total tax on the exempted value, which is a bit over $71,000, but we have to take off the school tax on that exempted value. So the property tax obligation for that property is reduced by about $43,000. It still has a tax obligation of $30,400, which is a combination of the tax on the existing value, the tax on the $100,000 land,
Oh, yeah.
and the school tax on the improvement value. And you'll notice if you add up the reduction in the tax
Would be
obligation
expensive.
and the remaining tax obligation, you get the tax obligation without any property tax exemption.
Sure.
We can do that again with a 50% tax exemption. There, instead of the full $4 million being exempt from property taxes, only $2 million is. So we see a lower property tax reduction and a higher remaining tax obligation.
Sure.
So this is how it's calculated in every year. Iowa state law tells us how to translate this into a multi-year policy. And this is through the exemption schedule, which shows the percent of the improvement value that's exempt from taxation in each year. The maximum amount of time for multifamily housing is 10 years, and the city could adopt any tax exemption schedule it wants as long as it's less generous than 100% exemption for 10 years. So it could be 100% every year, it could go down over time, really whatever a city wants to implement. The exemption schedule can also have a cap on the exempted value where any improvement over that cap would still be eligible for an exemption, but it wouldn't rise with the improvement value. And for some types of property, there's actually a cap imposed. So for single family and duplex properties and actually any housing that's not classified as multi-residential under state law, there's a cap of $75,000 of exempted value, and it can only go for 5 years. So this 100% for 10 years is only for multifamily housing.
I see.
State law also lays out the basic policy decisions that a city has to make to adopt tax exemption. I won't call all of these out, but I'll go through a few of them. First, the location of the urban revitalization area. It can be citywide, and it can also automatically include any newly annexed property to the city. Tax exemption can include a combination of new construction and rehabilitation or additions to existing buildings, or it can include just one of those categories. And then finally, an urban revitalization area can have a sunset. This is a deadline to apply for a first-year tax exemption. So a property could be getting tax exemption after that deadline if they apply for their first year pretty close to the deadline.
Are we allowed to add ADUs to type of property? I mean, those are single-family units on single-family unit properties, but if we wanted to really accelerate accessory dwelling unit development, could we add that in as one of the possible
I'm not sure.
beneficiaries?
I'll
Would
have
have
to
to be
look at if ADUs are
Like and I'm specifically thinking of that garage conversion, so separate unit, not an apartment within.
Yeah.
But does have to be multi-units too?
I
To
don't
be-
I don't know, but I would see a good benefit for us to, because my understanding is people are very interested in developing ADUs, but the gap doesn't work. It just costs too much to do it. But it's a huge opportunity for our city to increase density is to let people voluntarily turn that garage into an
But
apartment.
I could see an argument to say that is multifamily development.
Yes, that's what I'm
Yeah.
I
thinking.
don't know.
The language in the state law is that any housing that does not fall under the specific definition of housing as multifamily, which is 3 or more units on one parcel,
Yes.
is subject to this this $75,000 for 5-year cap. So it may be that if an ADU is on a parcel with one other single family home, then that would technically be a duplex or 2 units on one parcel.
Yes.
But I'll have to check on
Okay, yeah, the technical definition of duplex, I guess. So I always think of them as connected. So.
When you say subject to $75,000, like across the 5 year, right? Mm-hmm. That could be, I don't know how you calculate that. That could be like in 2 years and done, whatever it comes first, you mean? 5 years or 75?
It's both of them. So it would be $75,000 of improvement value can be exempted, and it can be exempted for only 5 years.
Okay.
So the way that this would work is if we go back to this example, the exempted, even though the improvement value is $4 million, the exempted value would just be $75,000.
I see. Okay, got you. Thank you.
And that pretty drastically lowers the amount of the incentive. If you think of the property taxes that a $75,000 dwelling
Yeah.
would pay, it's pretty low.
Yes, it's very low.
I want to pause again for any questions on mechanics.
Sorry. I asked my questions as you were going, so.
Good.
Yes.
Okay, great. So staff have developed this pilot for feedback using a lot of research on what other cities are doing. We've talked with staff from a couple of other communities and done a lot of modeling of how different scenarios would look for actual and hypothetical properties in Iowa City. We've landed on, for your feedback, a citywide urban revitalization area that includes an automatic expansion to include annexed property that gives tax exemption to any multifamily residential property of 8 or more units, new construction only, and gives a sunset of 8 years. This tries to give developers enough time to plan on this policy and get some projects off the ground, while also providing a clear date for council and staff to evaluate this policy and make any modifications. The exemption schedule is 60% for 7 years. This front loads the exemption a bit to focus especially on rental properties that may have trouble being financially feasible at the very beginning of when they're leasing up. And where this is really different from any other tax exemption policy in Iowa is that it applies not just 1 but 2 caps on the exempted value. The first is $150,000 per unit. This targets tax exemption at moderate housing, and also matches the state workforce housing tax credit, which exempts the first $150,000 of eligible costs. It's not an exact match, but it's as close as we can get.
What's the reason for keeping our pilot so constrained as opposed to just allowing all types or all comers to participate and then sort of test later whether or not it's having desired results? Is it we're just concerned about it being overly broad, or staff time at analyzing? Why would we tailor it so narrowly?
So the focus on multifamily is mostly because of this cap, the $75,000 cap.
Because you don't think it would be advantageous for any of the single family opportunities, or
It comes out to about, for one single family home, that $75,000 improvement value, the property tax bill would be lowered by maybe $800. It's not a very big
it's not
incentive.
enough to change the pro forma for the developer.
Exactly. It's probably not enough to bring a home from infeasible to feasible. So that means that the city would be giving out $800 to every new single family home without probably moving the needle on how much single family development is happening. So that's both, that gets expensive fast and it's relatively ineffective at increasing the housing stock.
Yeah. And the other question is, why new construction only instead of major renovations?
Yeah, that is more to focus the pilot on a smaller group first and see how it goes there, before expanding out to more types of construction. The requirement from the state that I didn't get into is the minimum improvement value. That is set at 10% by the state and means that a residential property has to have an improvement value of at least 10% of the initial value. So for example, if you have a $10 million property, the total property value has to go up by at least $1 million to be eligible for tax exemption. A lot of major renovations and rehabilitations would be eligible for that, but to guarantee it, focusing on new construction is a way to do that.
Because how you see the old like existing constructions will add to the goal of like adding more houses on the market.
I think that in my mind, there are opportunities in existing neighborhoods where there are maybe large houses that could be turned into multifamily units, or
But that's still new construction, right? If I have a house and I tear it down and I build the new.
If you tear down a building and build a new one, that would be new construction, right?
That's new construction.
and I was actually thinking about also existing existing apartments that might be in very poor condition.
Yeah, that means we are renovating it.
Yeah.
We're not adding. Yes, the value will be more, but we are not adding more houses per se.
Just improving the quality of housing.
Improving the quality of the housing.
But-
Yeah.
Okay. Yeah, I'm not against any of this. I just want to understand the why. So,
Yeah. But it would be, adding on rehabilitation or additions is certainly allowed under state law and would only be subject to that 10% minimum improvement value. The second cap is a $7.5 million total project cap at $150,000 per unit. This comes out to 50 units. And focuses tax exemption on this kind of mid-size range for multifamily buildings. It also helps avoid some interactions with TIF. If an urban renewal area and an urban revitalization area overlap, theoretically a project could be eligible for either TIF or tax exemption. No project can receive both. They're pretty mutually exclusive, and that would be in any agreement with a property owner that if they receive one type of incentive, they would not apply for the other. But we can use policy to steer properties into either TIF or tax exemption. So the $7.5 million cap really steers larger projects towards TIF and smaller projects towards tax exemption. That being said, anything over this cap would still be eligible for tax exemption. The amount would just not grow with the improvement value.
And can you tell me that you are a sunset 8 years? What that means?
So that means that after implementation of the urban revitalization area, developers would have 8 years to apply for a first year tax exemption.
Sure.
So theoretically, after implementation, there could be tax exemption going out for 15 years if we have the 8 years to the sunset,
Sure.
and then 7 years of tax exemption.
They could voluntarily choose to pay taxes for the first 8 years and then start the tax
I
exemption.
believe there is a deadline.
Okay,
It has to be
was like,
within
well, that's
a few
interesting.
years. You have to apply within a few years of completing the improvements.
Okay.
But theoretically, if a project is completed right before that deadline and they apply for tax exemption before the sunset, they could be receiving it after.
And the exemption is scheduled for 60% for 7 years. Is this like now not 100%, 60%? I don't understand that one.
So this would be
Because in the beginning we was talking about 100% starting and go
Yeah.
down.
So this was an example. 100% is the maximum that state law allows, but you don't have to do the maximum.
Okay.
So the 60% for 7 years gives a bit of a smaller incentive. It's not a full 100%. And in contrast to what our current policy is 40% for 10 years. It kind of
No,
front loads
60%.
that 60% for 7 years. So it's a little bit higher, but a little bit shorter.
Sure, got you.
And why aren't is this is an example, but are we
This is an
also
example.
yeah? But the proposal you have indicates would it be
60%.
60% for 70? Why aren't we proposing dialing it up to the maximum just because we're testing it?
Because we're testing it, and because 60% is, it can be enough to kind of make a difference in the pro forma for especially smaller buildings,
Okay.
but also doesn't start with kind of paying the maximum exemption we can. It can always be amended even before the 8 years if we're seeing kind of low developer take up, if we're seeing take up in projects that maybe don't fit the goals. Those projects would still be eligible, but we can amend it after that fact.
There is no way we can say with like we added like kind of affordability and we say 100% for affordability.
That is an option.
One thing that I mean, everybody knows because I always talk about it when it comes to things being non-market. I've always looked at some other models where it's kind of, there's a tax exemption, and then instead of an affordability requirement, it is an ownership transfer requirement for the municipality or some mission-driven non-market or non-market housing organization. A certain percentage of the properties just change ownership to the municipality. So I see, so when it comes to the 40% that we have right now in our tax exemption, would you characterize that as maybe the hesitation would be they are losing money on those units, or are they not making enough profit on those units?
I hesitate to speculate too much, just
Okay.
because I haven't talked to developers about it. But I would guess that some of it is the amount of money, and that providing those units at 40% AMI is a loss for the developer, and the amount of tax exemption probably doesn't make up that gap. And then the other big piece for any developer is going to be that administrative complexity. Developers could get around the funding gap by layering different funding sources, but then you really get into a longer development timeline, kind of layering not just funding sources, but also affordability requirements and compliance needs that just get very, very complex. And many for-profit developers may not have the experience dealing with those affordability requirements. So besides the actual, net operating income piece of it, there's also the administrative complexity and the experience that the developer has dealing with those affordability requirements.
What if it was something like you get 60, 80, whatever percent, and then 15% of the units become the city's property? Is that legal?
I'm not sure.
I'm not sure. Yeah.
Because then, as that prevents the onus being on them for providing all of these funding streams for because we have the experience doing that, or then we could sell it to another housing fellowship or something like that for a good price, or so I mean that's just what I've seen.
If I may,
Yeah.
I don't think tax exemption is a rich enough incentive to consider ownership transfers. We have done that in the past. If you think
Okay.
about Augusta and Chauncey, those were both multi-million-dollar TIF incentives that resulted in the city taking ownership of a handful of units, and that met the affordability requirements. So exactly what you just said. Tax exemption is a much smaller
Amount. Yeah.
incentive, and is really meant to just kind of bridge a cash flow gap and not necessarily provide a extensive public benefit beyond the housing supply. So what you're describing is something the city has done.
Okay.
But I think it's going to be on that TIF side. So if we have those larger projects, doesn't have to be a larger project, but if we have a project that we really want to see those affordability requirements in, we're probably going to have to look at TIF if the goal is ownership.
Yeah, that's why I think I look at it. Yeah, the break on the tax or the exemption is not that high per year, but I still think it's supposed to be. There is a way. I don't know how, but if we can still make some like affordable unit for 7 years, whatever time that we give them the exceptions.
So I can show you what this looks like in action, so you can see what these numbers would be for different theoretical developments.
No problem.
If we start with a smaller 15-unit multifamily building at that $150,000 cap, so a $2.25 million total project value, that qualifies it under the example from the slide before for $14,500 in annual exemption. That's 36% of its total property tax exemption, including the school tax. So it's less than that 60% exemption, but 36% of its total tax obligation. Over 7 years, in an imaginary world where the tax rate stays the same for that 7 years, this property would get just over $100,000 in exemption and would still pay about $180,000 in property taxes, both to the city, school, other entities. A more moderate building that's hitting both of those caps, so $7.5 million for the full project, $150,000 per unit, would get the maximum annual exemption amount of $48,300. This is still 36% of its total tax obligation, and for any, this is actually true for any project that's under both the per unit and the total project cap, it would have 36% of its total property tax obligation exempted. Over 7 years, it would pay about $600,000 in taxes and have $338,000 exempted. If we imagine a much larger building that's over both of those caps, so over $250,000 and over per unit and over $7.5 million for the full project, it's still getting that $48,300 annual exemption amount because the exemption value is capped. So even though the amount is the same as a share of its total tax obligation, it's much lower. It's only 4.3% of its annual tax obligation is exempted. Oh,
Just want to pause on this because this is a really important policy distinction that we're trying to make here and that you all would need to consider. When you think of the multifamily that has been built over the last 5 to 10 years, in large part, it has either been large-scale student or senior housing, and we're really not targeting that segment with this. So this large multifamily, that's why you cap, right? The benefit's the same whether you're building 250 or 50 here, because we're really not trying to do much on this part, but this tool is kind of a blunt tool, right? So everybody's eligible. So we really are de-emphasizing the large and trying to get that smaller multifamily, which tends to be the more market rate family, general population type of multifamily project that we have not seen an abundance of in the last decade here in Iowa City.
And similarly, it does not, our TIF policy does not apply to this. The city council's not voting on it. We're not tinkering with what they want to do. We're not telling them how they're going to do it.
Strictly
Yeah.
a supply.
It's, they get to just
Yes.
do what they want to do. And the idea is we get a lot more housing that way.
Yes,
They
yeah.
Supply.
through.
Supply. Yeah.
Yeah.
correct.
This is not the silver bullet to housing affordability.
No,
To be clear, that's not how we're presenting it. This is a housing supply play, just knowing how short we are on units. And as Nora pointed out in those early slides, how post-COVID our unit production is notably down in multifamily compared to pre-COVID.
Is that like a national trend, would you say?
It's a national trend. It's particularly bad in Iowa City. In 2024 and 2025, we had 72 total multifamily units permitted, and the beginning of 2026 doesn't show any change from from that trend. It's very sluggish in Iowa City.
But are you just like imagining that increasing the supply will reduce rent or the cost of the?
It would certainly ease the housing search for a lot of households. There's an abundance of evidence on the connection between housing supply and affordability. Where tax exemption policies can get it wrong is through that targeting and focusing on the first $150,000 of improvement value per unit is part of that, making sure that the new supply that's getting exempted from taxes is not the highest cost, is not the most expensive housing, but focuses on more moderate supply.
Yes, yeah, because you talk about the middle class families or whatever, middle income.
Middle income.
That's what I'm thinking. But it's still like, this is going to continue. Like, we're still segregating the low income people. We are not finding any, like, we're increasing this for 7 years. We're going to see like helping those people who are in like the middle income and finding houses, not like for like just in general. They will find houses, but it's still the people who are really low income. Those are the people who cannot find those kind of, because it will be expensive. Now, just to build is very, very expensive. I like the idea of supplying, but I want to see also like maybe doing another project or anything that could supply more, houses for those.
I think the city is doing that. We're just not talking about it here. Like the Summit Street project happens at the same time that this happens, and we are providing affordable, extremely affordable units using this one program at the exact same time. We're trying to get the private market to develop moderate income things. I think we have to do all of the above all at the same time because of our housing problems. I don't think that all
but we need to focus because we've been doing this forever. Since I joined this council for the past 7 years, I hear 80% of the area median income, 70, up like 80, I'm below, but it's still like 80, like I'm below all the time. But we did never have like something aggressive like only 40 and below.
What?
Yeah.
Isn't that the Summit Street project?
The Summit Street even is not that. It's half 60, right? Half 60.
We anticipate they're all going to be voucher holders.
Yeah, but still, it have like different kind of median income. Is not like specifically. It's the same thing like any another trouble with that.
I share the idea that we need to be approaching the very low income housing, but I also don't think we should stop developing everything else because of this.
I don't think you heard me. I said this is while we're doing this.
Okay.
We need.
All right. I did not hear that. I'm glad to hear that. That's what you said.
Why are we doing this?
Did we do this and do that? Okay.
Yeah, please.
Okay.
I don't know, but that's what I said. I said you heard me.
Okay.
I said it's really good to increase the supply with the hope that maybe more supplies would even reduce the rent too. That's also philosophy.
So I'm also curious as to, is it more a better policy? You think it's better policy, or we as a city are more concerned about the legal ramifications if we tried to put some affordability requirement in there?
The more compelling reason for me is that it's better policy to not include the affordability requirement. Even just the existing policy that we have right now. Like I said, part of this is probably because of the administrative complexity of getting tax exemption right now without urban revitalization areas already established. Mm-hmm. But I suspect that a major reason why developers haven't jumped at the chance for our existing tax exemption policy is because of that affordability requirement, both because of the cost and the administrative complexity.
Mm-hmm. Because I just wonder, the current tax exemption policy that we have, was it 40%? Mm-hmm. That just seems like a large amount. And so I'm wondering why necessarily going from 40% to 0. And I know that you were talking a little bit about how it's kind of hard to target, right? Because sometimes if you have a 50 or 60% AMI, sometimes naturally that will just be above what the market rate would be anyways. So therefore the affordability requirement just wouldn't make any sense or do anything. Is that what you're saying?
Yes, it's duplicative.
Yeah, and the percentage of units in our current policy is what?
Is 15%.
15%, okay.
Can you just explain again? I got confused over there. In the beginning I was thinking about, if the building is 15 unit building and we give them tax break of like 14,000, we're almost like giving them like per unit almost $1,000. But the more we have unit, the building will be like 250. Why the percentage suddenly become 4.3%? Can you explain that a little?
So that's because of this cap on the per unit improvement value and the total project improvement value. So the cap on those is $150,000 per unit and $7.5 million for the full project.
Okay.
So if any project has an improvement value more than
that,
it's only the first $150,000 per unit
we get that.
or $7.5 million will actually get an exemption.
I see. Okay.
I'm sorry.
But I just want to say, like, the more unit we got, it seemed like really less incentive we give, even though, like, if it's 150 cap, it's still, it's just, it's the same, like, whether it is 150, whether it's 50 or 15, at the end of the day, we're doing exemption has the same, right?
Sorry.
It's same exemption.
Yeah, so both of the small monthly
Because we it's 150 cap.
right.
Okay,
These are both
okay.
under the caps or at the
No,
caps.
I got it now. Yeah.
I'm also curious as to how we determine if something is considered student housing, because
We don't.
we don't.
We can't.
Multifamily.
Yeah, because I just heard I think
But, like-
earlier in the presentation where it's we've seen student housing development in seniors and those. So how do we?
Just how it's marketed typically.
Okay.
Replay, for example,
Yeah,
is this
like,
they only.
like Gilbane, the Nest, Replay, they clearly market to students, so we just refer to that as student-oriented housing.
Gotcha.
But I'm sure there's non-students that live in those buildings, just as students may live in buildings that we don't think of as student housing.
Yeah.
Yeah.
I can't help but to look at and I don't know if it's a little Easter egg hidden in this slide, but the per unit cost. And it 150 seems aggressive for a low cost price for a 50 unit. That's not what we're able to do on Summit Street, for example. But then I see the large at 250. Is there also a presumption here that these large TIF projects we're ending up buying basically affordable units at a really high cost? Is that what this is kind of saying too?
That's not what the message in this slide is. I don't know if you want to speak to
But is that also true that like our TIF policy is yielding affordable units but at an incredibly high cost, and this could be a way to get more units at a lower cost?
It is a lower cost per unit, a lower incentive per unit. It's also faster because any developer, any property owner can apply, and if it's eligible, then council would approve the application, and there aren't the negotiations that go into TIF.
But you chose 250 over 150 when you jumped from 50 to 250 units because
Just to illustrate that projects that are below these caps will get kind of a tax exemption that scales up its improvement value,
Yes.
and if it's over both of those caps, then
They pay more.
the exemption amount will stay the same. And I should mention too, we've discussed pegging the per unit and the total project caps to some sort of inflationary adjustment. Right now, as you say, $150,000 per unit is pretty low. In 5 years, that could be pretty laughable.
yeah.
I really get what you said when you said this is not really a lot of incentive. Yes.
This is not
Because when I really calculated, at the end of the day, this is just like $80 per unit per year
for
like tax exemption per unit. It's not a lot of money to require no, you should give us like affordable housing here. Or, yeah, I
Yeah.
got it.
Yeah.
Yeah, because like $14,000, if we just like, let's say the
Yeah.
first example, divided by 15, that's like 900 something per year. Divided by 12, that's less than, $100 per.
It's not a
And
very
it is not very,
Very similar to the commercial tax exemption. This
Yeah.
is really designed to get projects that are on the fence. Like, maybe I can do this, maybe I can't do this.
Yes.
Okay, this helps give me a little bit more security to get the project.
exactly.
This isn't, this isn't going to unduly enrich anybody. It's not going to substantially lower rents. It is gonna bolster supply, and we know
Yeah.
we need that now, and those projections say we need it even more in the future, so.
Sure. And also it have a sunset. So, no.
And so we really
Right.
think that per putting legal potential objections aside, if we were to try to like put into a formula 80, something above 60% tax exemption over 7 years, and then including an affordable housing element, we just think that creates too much red tape potentially, or that would, yeah. Is that what you're saying, really?
It would need to be a deeper subsidy,
Yes.
and we would need to ensure that the compliance is easy for market rate developers for-profit developers who might not have experience with mixed income housing to accomplish.
Is this like, is there a way we can add something like, it's not necessary, I understand this, by the way, it's not a lot of money to ask people anything, but I'm just saying, if we give like 100% like tax exemption for the 7 years and with optional for the developer to take it if they're going to provide affordable housing, is kind of optional thing, but anyway, if you want to get this, you still can get this. But can we put like something like optional?
That Yeah, that is an
That's a really
option.
good idea,
It's
yeah.
likely not going to be a deep enough subsidy that a lot of developers would take advantage of it.
Yeah.
A really
We learned something. We tried it.
Yeah.
sure.
Yeah. I just like optional. I don't have to do it, but still we have this.
Yeah.
I like it's a great
Thank
idea.
you.
I had in developing this this pilot, I had a conversation with the housing finance director for Chattanooga, Tennessee. They have a new tax abatement policy that matches the amount of tax abatement to the number and affordability level of affordable units that a for-profit developer provides. And one of the most decisive moments for me in making the decision around affordability requirements was asking her what the goals of that policy were. And she said that Chattanooga has strong multifamily development right now, and their goal was to encourage for-profit developers to include mixed income developments in their portfolios. Applying that to Iowa City, we do not have robust multifamily development right now. We're in a different place than Chattanooga is, and a different approach is going to be necessary.
Sure.
I think I saw in the memo that it said that developers are not looking at mixed income right now in Iowa City. Like, that's something that we are not seeing.
We don't see a lot of many multifamily developers with experience or a lot of enthusiasm for mixed income development.
I'm struggling with my uncomfortability.
Yeah.
And I appreciate you probably anticipating like the scrutiny. You know what I mean? I struggle with the reality of the situation that we are in when it comes to we live under this system and these circumstances where something that's basic for human survival, we need to try to make sure someone can make enough money off of it in order to develop it. I always want that to be said, that this is bullshit, that we live under this system. But when it comes to, I think that, you know, now that I sit down and hear you explain it, I think that I think it's well researched and well targeted, you know, and like Jeff was saying, it's not unduly making someone wealthier. It's just like for the people that are on the fence, it provides something that does not come actually at a huge cost virtually any cost, it seems like, of like taxpayers, you know, and it won't come out of coffers of our affordable housing. We are not giving our affordable housing money to these people.
Yes.
And I think that's an important distinction. That sometimes I will see other cities make that decision. It's like, okay, well, we are going to give these people money that we could be spending on deeply affordable units, that we could be spending on social housing units. I think that's an important distinction. So, thank you. Yeah.
Thank you.
Yeah.
If there is continued interest from EDC in continuing to explore tax exemption, the next step would be for staff to do outreach with local multifamily developers, kind of test some of our assumptions, and make any tweaks to the proposal before bringing it back to EDC. If full council is interested in pursuing tax exemption, state law outlines a lot of all of the steps to make that happen. Staff will develop an urban revitalization area plan. Council will need to hold a public hearing after staff notify property owners and likely occupants of the public hearing. After tax exemption is adopted, council can amend the plan through a similar process to establishing a new one. And then once it's in place, property owners will file an application for each first year tax exemption, and then they don't need to apply for any subsequent years.
Regarding, I think the first step you said was we're going to talk to local developers. How far, and I would maybe suggest we look at regional developers, because I think we should be attracting regional developers rather than just focusing on a handful of people who are here right now, because I think that has become a problem for us, is there's not, like, we want to draw people to choose to develop here and to invest here rather than like sort of waiting for the local people to act. So I guess I would encourage you to think local as the whole state of Iowa. Mm-hmm. So, sorry, frustrated about that.
That's a lot of outreach, the entire state of Iowa, but we'll give it a go.
I think I see construction trucks all the way from Sioux City to Chicago in town. So
Do the whole world.
We have this. I think that we. Anyway.
Point taken.
I think that we need to probably give direction moving forward. I would be more than happy to say yes, we should move forward with this.
Yeah, I want to see the outcome of like these conversations that you have,
Yeah.
and
I like your idea of having the program as presented and a secondary optional thing, and we could, I think, learn a lot from that. So I think that sounds like a really great idea.
Mm-hmm.
So I guess we should have a formal motion. I'll move that we move this to a work session, probably, is the next step.
We would actually
Or
come
come back
back to EDC
Okay.
for the developer feedback, get another round of thoughts, and then go to city council.
So,
I would also like to hear, if we can, from like local affordable housing providers, how they see it.
Sure.
do you need a formal action on this, or is this agreement enough?
I don't think we need an
Okay,
action. No.
perfect.
Cool.
You guys cool moving on? This
Yes.
meeting has gotten long, I think. So,
Yeah.
staff
We're
updates?
close.
Rachel? Nothing? Jeff, anything?
Nothing.
Okay. Old business, new business?
No,
I have none. Okay.
I have none.
Then I guess we're ready for movement to adjourn.
Yeah, move
So-
to adjourn.
All in
Second.
favor?
Okay.
Opposed?
Thank you very much for.
Yes, thank you for your
Presenting this.
presentation, well
Yeah.
researched. I appreciated that.